The original
Sure.
tweet, I think, says you're kind of perplexed about the hostility that the
Yep.
bootstrapping community gives VCs. Why does that perplex you?
I guess that I look at it that we're all working on the internet to create products and startups. And I don't really understand why, money has to be part of this story. I mean, obviously it's part of the story where, a company hasn't raised money, a company has raised money, whatever. But I just don't view it as, we're on one side, you're on this other side, and that we should be at odds with each other. And I think also, especially in 2021, maybe we can go into this more and more detail later. The VC game is just, or whatever, the VC backed companies are a lot different today than they were, 10 years ago. And like the VC demands and how investors think about startups and their founders and stuff like that. So I was bootstrapper back in the day, and I just think the narrative is wrong for 2021 and in the last few years, actually.
Yeah. Do you think it's only from bootstrappers though? Do VCs only get this kind of negative attention from bootstrappers? Is it unique to our community?
No, but I think like we're all working on the same side. We're all entrepreneurs that are building products and trying to build something great for our customers. And I mean, you also get it from like the press, and you get it from other people as well. But I don't know. I just feel like we're all playing on the same side, and that we don't need to like badmouth each other or whatever.
Like, are you talking about VCs and entrepreneurs, or venture-backed companies and bootstrapped companies?
I think I hear a lot from bootstrapped founders and bootstrap like early employees talking negatively about, oh, that company raised money, like they're definitely going to go out of business, or this unfair advantage or whatever. So yeah, I do hear like a lot of negative conversations from like the bootstrapping community, and you don't really hear it from the VC backed startups saying like, oh, that bootstrap company, blah, blah, you know what I mean? It seems to be mostly one way. And so I kind of don't understand it. And, as a former bootstrapper myself, like, I just don't get it.
Are you sure it's one way?
I mean, is it, do you think it's not?
Well, I mean, the old trope was VCs would look at bootstrapped companies and go, oh, well, that's a nice little lifestyle business you have. I mean, it's kind of dated now, but if you listen to my conversation with Jason Calacanis, it's.
You've never raised venture capital.
No.
And so you're fascinated by it, right? And you're fascinated by the exit. Have you ever exited and sold a company to Google or Yahoo or anybody like that?
No.
Right. So it's naturally fascinating to people, right? If you were amongst the people who has raised venture capital or sold one, it would just seem very transactional and natural to you. It's understandable that people, when they see Tumblr get bought for $1 billion, or people invest $100 million in Tumblr or whatever, they're just such big numbers that it's hard for people to comprehend. It's just, the numbers are so large that even when I came with this kid out of Brooklyn, I was absolutely like you, like, oh my God, it's big numbers, and how do you go that big, and whatever. And it turns out there's a lot of money in the world. There's trillions of dollars just sitting around, and people are bored, and rich people are getting richer and richer every month. These billionaires, have $50 million or $100 million in profits on their investments, and they're just sitting there like, okay, what do I do with this month's $50 million? Oh, I'll just buy a big house that's worth $50 million. None of us can understand it, but that's the truth. And when the stock market is roaring and their investments are roaring and the polarization was going, like, it's like, oh yeah, I'll put $10 million into this. I'll put $5 million into this. Why not? They're bored.
Yeah.
The market, the money is bored. Money wants to burn. Money wants to be spent. Money does not want to sit in a safe. Yeah. Money is intended to be gambled. Put it on black. Spin the wheel. Let's see what happens.
He's
a character.
Dripping. He's dripping with this kind of like, oh, that's nice. You and your little company. So I think some of that seems warranted, like those tropes that exist. Also, not just in bootstrapping, but like there's the reason that like Twitter accounts like VCs congratulate themselves as a thing is because this is like on public display, you know?
If you want to be rich, you go to the bank.
Yes,
you go where the money is. You find the money at the bank.
Yes, bro. Fucking talk that rich shit, bro.
Find the money. Be the money.
That's, bro.
Oh, you don't see me at the club? I sleep at the bank.
Like I was listening to a podcast, and this venture capitalist, Roy Bahat, I think his name is.
Mm-hmm.
He was saying one of his funded companies was talking to him, and he was mostly great. He was talking on the big technology podcast. But the company was saying, how come VCs on Twitter are so gross?
So,
a question I got asked by a founder in our portfolio is like, why is VC Twitter so weird? Meaning, like, why when people are talking on social media and they're venture capitalists, are they like just kind of gross?
So I think we need to set that. Yeah.
And that's a pretty, what's on full display, what people see on Twitter and elsewhere. And some of this is satire and some of it's not. It's just like these kind of braggarts, obnoxious braggarts on Twitter.
Yeah, I was just gonna say, I think you need to separate the VC from the VC funded company and the entrepreneur. And that's where I sort of take issue with it when people are attacking the company that is venture backed, must be, having bad practices and like only caring about growth and only caring about revenue and that kind of thing, versus, the VC public investor that's on Twitter who's spouting their mouth off, I attack those people too, but I just feel like as a bootstrapped founder, not every VC backed company is like the devil. And I think there's that sort of,
that I think that's fair. I think I'd agree with you. Although I'm still wondering, because you say that it shouldn't matter, but it feels like capital changes lots of things. It changes lots of dynamics in society. And I don't feel like it's as, there's like implications for capital. Capital makes waves. So do you feel like that piece, the fact that there is so much, like as soon as there's a lot of capital in a category or in a company, that must change something?
I mean, it probably changes the market dynamics, but I don't think it changes necessarily the individual startup and their focus. As a company, like obviously you can do a lot more with money, of course, like you can hire more people, you can do marketing, you can do more paid marketing. There is definitely a different sphere of type of company you're building as soon as you take $1, but I don't think it's necessarily like a negative, or it should be even looked at in like a negative light. So I think I was arguing with the people on Twitter saying like, it's the entrepreneur running the business the way that they are choosing to run it. And I think all the issues should be directed towards that individual person and the founders versus just the fact that they raise, $1 million or $5 million or $10 million. Like, yes, it changes the company's dynamics, but it doesn't necessarily change, how we treat our customers or like the type of products we have or our integrity or, just because you take money doesn't mean you're like, some terrible person. And I just think like that dynamic is just like a little dated.
Yeah. And so let's dig into that, because I'm curious about it. Like there's this old, like on Silicon Valley, the show, there's a scene where that venture capitalist guy, what's his name? I can't remember. But the CEO is giving a presentation and saying, okay, we're going to adopt a SaaS revenue model. And then the VC hears the word revenue. He's like, hangs up his phone. He's like,
what? Revenue? No revenue. I'll call you back. What? Why would you go after revenue?
Because to make money?
No. If you show revenue, people will ask how much, and it will never be enough. The company that was the 100x or the 1000xer becomes the 2x dog. But if you have no revenue, you can say you're pre-revenue. You're a potential pure play. It's not about how much you earn. It's about what you're worth. And who's worth the most? No one wants to see revenue. Go.
I just thought that mainly the goal of companies is to make money.
Yeah, no. That's not how it works. I don't want to make a little bit of money every day. I want to make a fuck ton of money all at once.
And that was like the old narrative. And that's certainly, I mean, I've worked for those companies. I've consulted for those companies where there was VC money and it affected everything. It affected the KPIs I was given. It was affected how we treated customers, how we acquired customers, and what we were reporting back to those folks. So do you think that that's just not the case anymore? Or there's just a small number of good VCs that don't require that kind of,
well, I think
that
so.
system?
There's a couple things there. One, obviously, like that's not a parody, but it's definitely like they're trying to make a joke and they're pushing a narrative, whatever. But
I've been in those meetings. I have been.
Yeah, I don't think
they're like, don't show revenue because that's not what we're about here. You show revenue and it's instantly, this company is not worth as much as I need it to be. And that's the pressure I've felt as an employee and a consultant. Like, this is coming not from the CEO. This is coming from investors who also have board seats that are saying, we need to hit these numbers because of this, and anything else is a distraction.
So I think that there are companies that obviously adopt that philosophy. Clubhouse comes to mind as a, like, no revenue, just user growth, et cetera. I don't actually think that that's necessarily a bad strategy for a company like Clubhouse, for example. But I don't think it's like a blanket statement where all VC-backed companies don't want revenue, all VC-backed companies only want growth, that sort of thing. I think it's definitely product by product. Like, for example, ourselves, like our investors were not focused on revenue in the first few years as we were company building and so on. But I also wasn't as an entrepreneur. I think we started charging after 12 months or 18 months after we sort of founded the company or whatever, but it wasn't my focus because I wanted to work out the product. I didn't want to like necessarily throw a paywall in too early, whatever. But then by the time, we got into years 3 or 4, like revenue is actually the only number that matters nowadays. But anyway, to your point, I think it's just like, there are companies where that strategy is actually just that is the best business strategy for that company. Like, for example, going back to Clubhouse, if Clubhouse charged a SaaS fee from day one, it would be a dead product. That's the goal of the product that they're building is to amass customers. And so for that case, I definitely think it makes sense, that strategy. But again, it's just a blanket statement to say no venture capitalists care about revenue. We only care about growth, like that sort of thing. And I think that's where I'm trying to sort of fight back the narrative a bit.
Yeah. Well, and I mean, I think it's worth, like, let's take that Clubhouse scenario, because that does seem like different than, what you've done. But the idea that that's not without even ethical and societal implications. So this is where, like, I talk about overcapitalization. The idea that you can invest millions or billions of dollars into a category, and for it to not have additional effects, unintended effects, externalities, that of course there's going to be those things. And some of those things, it's like, sometimes we treat capital like, oh yeah, like capital can just burn. These investors can just waste that money. And, it doesn't hurt anybody. It's just it doesn't hurt anybody. But in truth, it does hurt somebody. It hurts LPs who have invested the money and lose it. A lot of these VCs get paid regardless, right? They're going to get their carry or their management fees regardless. And it hurts the category. Like, people lose jobs. People invested their time and their soul and their energy into those companies. And sometimes you'll get a big investment in a category. And because there's no focus on real revenue, all the base fundamentals of a category go out the window. And then it's like when the big behemoth dies, everything dies, even though there was a wonderful ecosystem there before. The idea of pumping all this capital in, and if it doesn't work, you just like clear cut the whole area. And then what's left is, a whole category of folks that don't have jobs. And
you have an example of that? Because
sure. I mean, Quippy is probably a good one, right?
Now, Quippy was a historic bet on a new type of content, and it's shuttering just 6 months after launch is a dramatic failure for this. Jeffrey and Meg.
All my friends who are in show business, I have friends who worked for them.
Quippy. You're right.
And everyone was excited about it. Creators were getting funded, the projects were getting funded. They were feeling good. Artists were getting their work on a platform. And it was a lot of money. It was $1 billion, I think. And then when it crashed, sure, maybe I'm sure, Katzenberg is upset that he's lost his money, and his investors are upset that he's lost his money. But it was almost $2 billion. That when in the after effects of that, my Twitter stream and Slack groups were just filled with people who had lost their jobs or no longer had their project going or whatever. And in a normal economy, those things would just happen naturally. We've got money, we've got revenue, we've got expenses. This is kind of the normal cadence. But you pump a bunch of money into a category and it can kill it. It has an effect, You can't just invest $2 billion into a category and then expect it won't have these other effects on society.
Right. But I would say I was actually a brief trial user of Quippy or whatever, but I would say that one, I think that's sort of an outlier because most companies don't raise $2 billion pre-product, which I think, or pre-launch, which I think that was, their case. But also you could also argue that it might have influenced the category in the idea of there was a lot of learnings coming off of that product where maybe, if we had reimagined the product this way, it could have been successful. I think future entrepreneurs will be born out of the ashes of Quippy. I think also that the creators that created content, I'm sure they got paid because the content launched with there, so they got paid. And then also the assets were acquired by Roku or something like that, I believe. I think
for 100 million.
Right. But some investors lost their money, of course, but they're also in the game to lose money too. They are investors. I don't feel necessarily bad for them because, they're rich funds and so on.
I think it's still a good example. We can't put too much lipstick on it because that there's clearly other effects. And even if the VCs end up okay, and even if Katzenberg ends up okay, and even if the LPs end up okay, although certainly you've got to imagine some of them didn't, there is still all this other collateral damage that never seems to be in the narrative. But what about all those people who quit jobs and moved to New York to work on this and thought this was going to be, their career, and now all of a sudden they're out of work. And the difference is the way and the pace and the fundamentals of business that most businesses have to run on, right? Most businesses, you don't hire until you can afford to do so. Hiring is always a risk, and taking a job is always a risk, but even more so if you're investing billions of dollars in something, just has a higher chance of not succeeding. I also wonder about wasting all those billions. I'm still not convinced. For a VC, it's an efficient use of capital, but for the rest of the world, watching billions of dollars burn is just it just seems so sad,
Yeah.
Because it's not an efficient use of capital. There's all these other ways you could, use the capital.
Well, you could argue that if it was successful, it potentially could have been a good use of capital. But yeah. But I think Quippy it's not the normal, it's not, but it is the normal
because aren't 8 out of 10 investments not working out at all?
Yeah. But, 8 out of 10 investments, they're $1 million each or $2 million each versus, $2 billion investment. I think you could also argue that Quibi could, well, I mean, I think you could definitely argue that Quibi would never have been successful as a bootstrap business. You couldn't even imagine building that company without funding. It just would never happen. I mean, how would you get, these famous actors to record shows and pay them and, go through their agents and so on and so on. So, I don't think it's a company that could have ever been bootstrapped.
Yeah. I mean, there's still something about, and especially because there's not a lot of transparency at the beginning, right? So public companies, that was the old model, right? Like you go, okay, we got an idea. This is a big idea. We're going to need some money for this. So we're going to take this company public. And as soon as you take them public, you've got transparency into the business model. And then the stock kind of has to prove itself. But in this world now, that's the other kind of knock against venture capital, is that companies are staying private for so long, and you're investing billions of dollars into an ecosystem, but there's no transparency. Nobody really knows what's going on, and there's no accountability really, right? Like there's not shareholder meetings where they're able to go, hey, and the shareholder meetings aren't public. So nobody really knows what's going on until afterwards.
Are you talking about the people that don't know what's going on are the employees themselves, or you mean who are you talking about?
Yeah. I mean, I think employees, investors, partners, the government.
Well, the government knows, they have your tax info, but yeah. I mean, I would say that
there's a lot more oversight in the public markets.
Yeah. I mean, I would say that, again, it depends on how the entrepreneur's running their company. You can be completely transparent with everything for all of your employees, which, for example, we are. All of our employees see our board decks every quarter. They see all the numbers, they have access to everything, et cetera. I mean, we're a 28 person company, not Quippy, but I think it definitely is, what is the entrepreneur's vision for the company, whether they're bootstrapped or not. Like when we were bootstrapped and I was running Carbon Made and we were 12 employees, our employees didn't really have much insight into our numbers and our metrics other than our top line revenue. It was just something that, as like a less experienced entrepreneur, that's what I thought was like the way to do it. Whereas now, VC backed, we actually have way more transparency around everything. So again, I think like coming back to the narrative,
but there's lots of bootstrap companies that are transparent.
Yeah, of course. But there's also lots of VC backed companies that are transparent. So, I mean, that's kind of where
it doesn't matter. But so in that case, transparency doesn't, whether you're transparent or not, it doesn't matter. It's not like a requirement that it's not like VC backed companies are more likely to be transparent, is it?
I would say no, it's not. But I would say there is things that you have to, like having investors, you have to be transparent with them. There's actual legal requirements in our documents where not only our board, but there's this thing called a major investor threshold. If they own a number of shares, we have to disclose financial data, stuff like that, to those investors. So there are certain things like in our legal documents, and I don't know if every VC-backed company has this or not, but I'm assuming most do, where we actually do have to be transparent with our investors. And you could say that as a bootstrap company, maybe you don't need to. So
yeah.
But I think the narrative for me really is just like, the thing that I was trying to talk about on Twitter is really just like, it's the entrepreneur. It's not whether or not they took money. And that's kind of where I sort of wanted to go forward with. Like, that's what's important to me.
Yeah. Okay. I do want to get to that. I just want to have one more dig at big name VC, because I think it plays into this. Some of this reputation is deserved. And I think the other thing that is upsetting to me is that venture capitalists, the big ones especially, have a big impact on society. And I'm not convinced that the big names, Andreessen Horowitz comes to mind, are actually good for society. And because they're kind of the leading firms, they're the ones writing the biggest checks. They're the ones who have accumulated the most wealth for themselves and their LPs. I think we should be holding them to account. And I think some of that negative attention is dripping down to all VCs, right?
Mm-hmm.
So when Andreessen writes, we have to build, that big essay, I'm with him. I'm like, yeah, we have to build. And he's talking about, this is how we're going to solve climate change. And then he writes no checks that do anything to solve the climate crisis. I think he's invested $4.5 million in one company. And then he writes he creates a $515 million crypto fund. The hypocrisy it's maddening. And I think the negative attention, he should be held to account. He actually asks people to hold him to account in his essay. So I think that there's some of that, the big names people see who are kind of, you would think are kind of the people leading the VC culture, setting the tone. They're really disappointing. And it feels like we almost need more. We need to hold them to account more, like not less. So bootstrappers, people who receive funding, whoever you are, just regular citizens, need to be looking at these companies critically, these funds critically, and going, what are you doing? And actually holding them to account. So I think that's part of it.
I agree with you that, and I don't know all the I don't know Andreessen Horowitz, all in their investments, but I have no problem with, bootstrapped entrepreneurs or any entrepreneurs holding a specific venture capital firm to be accountable. I think where my issue is when people say like broad statements where like VC means X, VC means Y. That's where I kind of rubs me the wrong way, because I am someone who's raised VC and I'm not those things. And I just feel like those sort of broad statements where like, if you were to call it Andreessen Horowitz, like at P Marca on Twitter, like blah, 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 you're doing all these things. Like I would support you.
I have,
yeah, I'm sure you have. Like I support you. I think it's just more just the broad view of like VC backed companies as a whole. And that's like where, and because I work, we have quite a few investors on our cap table, and they're amazing. They're so kind. They're so supportive. They let us run the business how we want to run it, et cetera, et cetera. So I just think it's like, I prefer to like call people out individually than just like this broad sort of statement. And I think 10 years ago, like we were all I was saying that as well. Like I was calling out the VC industry. But now that I'm in it, there's plenty of great companies. There's plenty of great entrepreneurs, plenty of, there obviously are terrible ones, but again, like let's talk about those people individually and let's not be like using these broad statements.
Yeah. I still think broadly the culture seems toxic because it's all and how are we going to quantify that? Are we going to quantify it as total number of dollars invested in a year and what percentage of that is good for society versus not? Are we just going to say we've evaluated the 100,000 VCs in the world and 2% are good and 98% are bad? Like of course, some of these things are difficult to quantify, but the biggest funds to me are disappointing. And it feels like it's worth calling that out. And I don't know if that's fair to say those encompass most of the culture, but it's just like these funds are not good. They're not.
I mean,
and go ahead.
No, I was just say like, I'm sure there are plenty of investments that they've made in companies where, we probably use their software and we enjoy their products. And I'm sure the founder's great and the team is great and everyone's happy. So again, I think like you can't necessarily call Andreessen Horowitz for being 100% shady or whatever. Maybe, they aren't walking the walk and based on certain things they've said, and maybe they're not investing in certain companies. But I think, again, it's just like to attack them broadly when there's so many people that are doing great things that are portfolio companies of theirs. It feels like nasty to me.
Yeah, but that isn't, in some ways that is, if the structure feels and looks not great and the incentives that are set up within the structure, this is my concern. And this is what, and maybe I'm wrong, but even the incentive structure. So venture capitalists, and I'm just a dummy, I'm still figuring this out myself, so maybe I'm wrong, but my understanding is that they raise money from LPs and they then invest that money in startups. And already you can see, like, there's all sorts of, the incentives are going to kind of dictate how they go about doing that and the structure of the whole enterprise. And so if you've got management fees of 2% per year and you raise a $100 million fund, you get paid $2 million per year regardless. And sure, you got to pay your employees and everything like that, but $2 million a year from that fund, no matter what. And that seems like already that's an incentive that's going to have an effect on what you do and how you do it, how you behave. And then the 20% carry means that you're going to optimize, again, you raise 100 million, you really want it to return 300, right? Because that's where you're going to make your money. And so it's going to optimize certain types of liquidity events and everything. So there is a structure that's being built there, like with incentives and everything else. And I think it's okay to criticize it, especially since the numbers are so big.
It's just, the numbers are so large.
So, I mean, I guess
trillions of dollars being invested really by mostly white men in whatever they kind of fancy and whatever gets, being fed by whatever incentives they're being incentivized by. I think it's okay to criticize that. That seems fair.
I guess I mean, I would say maybe it's fair. I don't know if it necessarily is. I mean, think about all the money that has gone into all these products that we use on a daily basis. We talk on Twitter, we talk on Zoom, you use Chrome, like almost all the products I use on a daily basis are venture backed. And you could definitely argue that those companies and those products would never exist today if they were bootstrap businesses. And the only way to launch those products is to raise venture capital, and the venture capitalists need to make money, and they need some sort of amount of money to be able to, they need that 2%, whether it's 1%, 2%, that you could argue that, but they need some amount of money to live, to deploy this capital, to invest in startups. And then the reason there's a 20% carry is to align themselves with their investors so that, they are incentivized to choose companies that are going to be successful. And so I don't necessarily think that that's such a bad thing. And actually, I just learned this history fact recently. And when all the shipping, I'm kind of a little bit ignorant on this, but all the shipping that happens way back in the day, that's when carry was invented. And like different ships would take different carry in other people's ships, so at least one of them would be successful if one of the other ones crash or something like that. So this is a thing that has been happening for hundreds and hundreds of years. And I don't know if it's necessarily a bad structure. I would be curious to hear how you think you can make it better. Because
I mean, and the shipping one's a good example because it did have effects. It had environmental effects, for example, like almost the elimination of the extinction of a bunch of whale species. And that was directly tied to the incentive structure, right? Like, we're paying you guys to go out and get oil blubber. You better do it. And you're going to risk your lives. Most of the ships didn't make it back. Lots of people died. So the history is important. And especially because there were effects, there were knock-on
But if there
effects.
wasn't carry, your ship went out in the ocean and it crashed, your wife and family would have they wouldn't be able to live. But thankfully there was this, sharing of carry between ships so that your wife and family would be taken care of. So, I mean, there are potential negative consequences, but there's also positivity and globalism and so on, and countries trading. And, we are where we are today because of the early shipping industry. But
Yeah.
But yeah, I mean, I would be curious to think about like how else could you structure this thing to make it better.
Certainly for bootstrappers are always going to be reliant on doing arbitrage from bigger companies that are paving the way. So to build an audience, you need to do arbitrage on Twitter, which is a big public company. To have a successful SaaS, you're going to need to do arbitrage on Google search, which is a big $1 trillion company. So there is that reality that's true, that in our economy, bootstrappers are going to need to do that. And the nice thing with Twitter and Google and et cetera is that they have gone public. So now there is just way more accountability. And the government can certainly, and we'll see if they do more, but they can hold these companies to account if they want to, and hopefully create a tension that, there's these big companies, they can exist, but there's someone else kind of holding the line. I think these smaller funds are interesting, like Earnest Capital and Tiny Seed, for bootstrappers, where they get some money to pay their bills for a year or two. I think that's interesting. And some of this is going to come down to the entrepreneur. So let's finish off kind of in that area, because I think I want to push back on some of this. The idea that it's like all up to the entrepreneur. It's almost like you wanted to say, the VCs are off the hook. Like this is really all up to the business. So maybe explain what you mean by that.
So, I mean, as the founder, whether you're bootstrapped business or VC-backed business, I firmly believe that the buck stops with you, and you are setting the culture and the tone for your company. And I think from day one, we all start at the same place, whether you're a bootstrap company or you're a venture-backed company. You start with an idea. Maybe you have some notes, maybe you have some designs, maybe you have a little code, whatever. We all start at the same place. And then I am choosing as an entrepreneur to go out and raise money. And I am going into that situation, understanding the consequences. I now have a boss. It is my VC. I now have money that I need to eventually return at some point in the future, or go, public or whatever. So I'm signing those contracts. Like, it's not with blood, but it's with a signature, and I understand it. And so, and I'm choosing to get in bed with that venture capitalist. Like, I can do my research. And I've done this. Like when we were first taking money, I was reference checking my investors. And I was like, can I speak with your portfolio companies, et cetera, et cetera. And so I am taking on that responsibility. It's my choice. So when my company chooses to, prioritize growth over revenue, that is me as an entrepreneur, because I've made the decision to take capital or whatever. But I can also push back on my investors. I can write my legal documents where I have full control and so on, and I can focus revenue versus growth. So that's why I say this is the entrepreneur's choice. And yes, like you've made a conscientious decision to take capital and you understand the consequences of that. But at the end of the day, buck stops with me, buck stops with you, et cetera. So that's why I kind of say like, yeah, you chose to take $100 million from Andreessen Horowitz for Clubhouse. You know what game you're playing. That is you. That's on you. That's not on Andreessen Horowitz. So that's kind of where I'm going to get at with that.
Yeah. This isn't a perfect analogy, but I think the thing that immediately sprung to mind is as an employee, when you go out job hunting, it's up to you. You have the responsibility. You're applying at places. You can do background checks. You can check up on people who have been there before. You can do all those things. But when you get hired as an employee, there is still a power differential there. There are still power dynamics at play. And there's still, rightfully so, like government intervention, for example, to make sure that employers hold up their end of the bargain, that they're being held to account, that potentially dangerous employment behavior, potentially dangerous, toxic behavior. So it's you could say, well, why'd you go and work for that company? They're a bunch of assholes. Why'd you do that? It's like, well, there's still a flip side to that. There's still something else holding the tension, which doesn't let the employer completely off the hook. And I think putting it all on entrepreneurs seems a little bit unfair, because there is a power differential. There's power dynamics at least at play. And we can't blame everybody for being naive, because there's always going to be a certain amount of naivete. There's always going to be bad actors. And so just saying, well, to the entrepreneur, well, you should have known what you got into there, like who knows? I think there needs to be somebody holding people to account and saying, okay, well, and whether it's government or whatever, but maybe we should have more rules about how dilution works. Maybe we should make these vehicles less complex and more easy to understand. I don't like it when we put everything on somebody and say, well, you dumb entrepreneur, you just made a bad decision. You chose a bad VC. Seems a little bit unfair in some ways.
I mean,
when you need capital, you're going out searching for capital. But you
understand, like, you as an entrepreneur understand that when you're taking capital, it is not risk-free. And that is number one. Everyone knows this. If I take a loan from the bank, if I borrow $10,000 from a friend, I've never done that, but if I did, it's not like it's not a gift. There are strings attached. I think that you should be held accountable because you are entering into that relationship. I think the employee situation is different completely. And I don't think it's really related to this conversation so much, because I think, that employee has the same issue going to a bootstrap company versus a VC-backed company. But I do feel as if that the entrepreneur, they can read the legal docs, they can consult their lawyer. They know, because everyone knows when you take money, there are strings attached. And yeah, I do think it is. Like, you can choose the venture capitalist you want. You can choose not to take money at all. You can go the bootstrap route. You can choose to take $1 million or $2 million. You can choose to take at this valuation versus this valuation. So yeah, I mean, I don't know. I don't think I waver on that personally. I really do think it stops with the entrepreneur.
I think you would waver on that if all of a sudden you got fucked. Because you could read all the documents and sign it, get your lawyer and all those things. And then still somebody can do something shady or do something that's legal, but not super nice. And you just didn't know about it, or you didn't know that was possible. And it can come back to get you. So
this is a good thing that I meant to bring up, actually, because I think one of the perceptions from people is that investors are like omnipresent, telling you what to do, like looking over your shoulder and stuff like that. Like, nothing can be further from the truth. We check in with our investors once a quarter. We have a board meeting. There's a couple of emails here and there. But that's more typical than the other way around. It's not like they're saying, Spencer, you need to do this feature versus this feature. I haven't had a single piece of feedback around our product since the first days. So I just,
how is yours set up? Is it a safe?
No, we did like a price round. So it's like there's no safe. We never raised debt. We always raised just like straight equity for cash, which is, we could go down that whole nother.
What do you think about safes? What do you think about safes, especially in the new crowdfunding?
So this is my bootstrapped roots. So for everyone listening, like, I was a bootstrapper for my first 3 companies, and now I'm, raising money. But my bootstrap roots say that I want to take cash and give a piece of the pie so that I just know what I've given up, So like, these aren't the numbers, but like, I want to take $100,000 and know that I'm giving someone 10% of that company. I don't like this idea of debt, or, maybe it's, this valuation, maybe it's that valuation. I just personally, that doesn't sit right with me as someone who wants to just like know how much I own, know how much my investors own, that sort of thing.
Yeah. I mean, that seems, I think where we agree is that I certainly there's got to be good investors out there.
Tons of them. I've met way more good ones than bad ones. Like,
and sorry, and when you say investors, are you talking about LPs or venture capitalists in the middle?
I'm just talking about VCs and angel investors and stuff like that. I don't know. I've never met an LP. I've actually met some LPs, but they tend to also be venture capitalists. It's very weird. There's a lot of venture capitalists that are also LPs. Like they invest in each other's funds and stuff like that and whatever. But yeah.
Yeah. Okay. I mean, but so that, I mean, even then, like, why not just take, if you could, would you prefer to take money from angels, for example, who are directly investing their own money as opposed to somebody in the middle?
So I actually have a good answer for this, because if you raise money early on, this is sort of off topic, but if you raise money early on from only angels, it makes it really difficult for you to raise another round of funding if things aren't going super well. So, you know, say you raise $1 million from 50 different angels and then things aren't going that well. There's unlikely that one of those angels is going to step up and be like, I'm going to write a big check into your next round. Where typically if you raise from like a VC firm, you know, say they put $500,000 into that $1 million, they're incentivized to make sure that you don't burn out. So they'll likely to invest more money to see you through another day. So I personally I don't like the what's called quote unquote party rounds, because like I want to have someone who has skin in the game, because we have quite a few angel investors as well, but I never talked to them and I haven't spoken to them in years. But we still talk to like our major investors, because they're like in it, you know, because they have a much bigger percentage of the company. So I personally, if you can go the VC route, even those like micro VCs, small VCs, I sort of recommend that.
Yeah. I mean, I think it's interesting. I do like your perspective. I like that you're going against the grain in definitely in my culture, because it does seem like there's got to be a place for taking investment from people that aligns with your interests, that aligns with your employees' interests, that aligns with your customers' interests. What's your advice on how to find those people? Like, because I get pitched all the time, and you know, all the emails, the cold emails I get don't give me a lot of confidence. So what's your advice on, and certainly, you know, I think most folks have figured out they can raise smaller rounds not without too much difficulty, 100 or 200,000. But if you wanted to raise, like, how much did you raise for Podia?
We haven't talked about the total amount, but I can talk about like the first few rounds. I think our first round, we raised $750,000.
Okay.
And about, I think 250,000 or so was from a single VC that was kind of like leading the process with us.
Got it. So if you wanted to raise $1 million now, and you were looking for somebody, you know, some people investing in the fund that would be good actors, what would you do? How do you do that?
In terms of finding good VCs.
Yeah. Is it just who you know? You just got to build relationships. Is there a glass door for venture capitalists?
There is, and there is one. I forget the link right now, but my friend knows the person who runs it, who's anonymous, but whatever. I mean, I think one of the best things to do is just to talk to startups that you know have raised money, and just reach out to the CEO and be like, you know, who are your investors? Do you like them? I think that's one approach. For me, just living in New York City for 15 years, and I just kind of got to know people in the community, and the person that actually wrote the first check into us was a former entrepreneur, and we met when we were both entrepreneurs back in the day, and now he's a venture capitalist. So like that was my sort of intro there. But I think, as you said, like it's fairly easy, and obviously not everyone can raise money, but there's so much money out there right now. It is quite easy to raise that like a couple $100,000 round from investors, AngelList, Republic, whatever you want to do. Yeah, I mean, there's money out there, and there's never been more money.
Yeah. And I think another place where I've moderated my stance is listening to you and Addie Pinar,
Mm-hmm.
I think the thing about bootstrapping that a lot of people don't talk about is that it does take a toll on you.
Yeah.
And in retrospect, what we were able to accomplish with Transistor happened fairly quickly, but getting there, so the multiple things I did before that definitely took a toll on me.
Yeah.
And I think if you, Addie's talked a little bit about this, about, the bootstrapping when you have a family, and the pressure it puts on you. I think there is an argument that if you can use somebody else's money to learn, definitely, that's not such a bad thing. If you can use someone else's money to give you some breathing room and give you some calm, of course, the flip side is you just want to make sure that it's structured in a way that it is actually going to give you some calm, and that the incentives are aligned in that way, right? Like that you're going to get this check and it's actually going to make your life better, as opposed to make your life more stressful.
So that's actually a really good point, because when I was first starting this company, I wasn't planning on raising venture capital at all. I was bootstrapping it. I wrote a $30,000 check into the business. And I used that to hire our first contractor and so on and so on. I wasn't planning to raise money at all, but I was also, getting older. I was dating my now wife, et cetera, et cetera.
Yeah.
And like, I wasn't sure that I could go the like full on bootstrapped zero salary. Like I'd made some good money from previous exits, but I didn't make enough to like never work again. Right. So I needed something to come in. And actually, it's a funny story, because I'll just touch on it really quickly. I met a VC for beers at a beer garden in Brooklyn, like so stereotypical. And super nice guy, Nick Churls. They actually led our seed round from Notation Capital. Anyway, we were just outside having a beer, and he was like, "Oh, what are you working on these days?" And I just pulled out my laptop and I showed him some screenshots or whatever. And he's like, "That's really cool. Like, do you think you'd be interested in some, raising money?" And I was like, "I wasn't planning on it, but like maybe." And 3 days later, he sent me a term sheet, and I was like, "All right, let's do this."
Sure, let's do it.
Let's do this thing. But the security was a big thing. Honestly, that was huge for me.
So on that topic, because I just had a call with a guy he's younger. I think he's raised 20 million. And I was like, man, congrats. That's great. Like, you must feel like you've got all this margin now. And it didn't seem like he felt like that. There was a lot of pressure to not pay himself super well, a lot of pressure to hire and use all that money. So for you, were you able to pay yourself well? Did it actually give you margin in that sense?
I mean, not off that first check. I paid myself, but not a big salary. Let's just say that. Pretty meager salary, but it was enough to sort of cover my expenses, my rents, healthcare, whatever, and sort of leave me not like draining my bank account. But I think there's also a really big difference between raising $20 million and what you're getting yourself into, and raising like a $750K pre-seed round. Much different expectations. So it goes back to my point earlier about the entrepreneur. Like, as an entrepreneur, you need to know that you should know that taking $20 million is a lot of money. Taking $750K, less money, less strings attached. People aren't going to be as upset if you lose all of it. People aren't going to be breathing down your neck, that kind of thing. But you can get to the point where you raise $20 million, but like I personally would never do that sort of day one.
Yeah. Do you have any? I got to go to the water slides here right away. But
sure,
do you have any tips for people who are looking what's a good term sheet? What lawyer do I talk to? Like, where should people get started if they're looking for a good setup? Because honestly, like if someone sent me a $750,000 term sheet, I would have no idea if it was good or bad. Like, is this a lot of strings? Is this not a lot of strings?
Sure.
Man, they're asking me a lot of questions. I don't know. Like, should I answer these? How do you navigate that process?
Yeah. So the term sheet is fairly simple. I think ours was like a 1-page document, maybe 2 pages, that just sort of outlines the real high level parts of the business. Like, you're raising this amount, there's gonna be this percent, whatever. And I remember I just took it, I read it. It's fairly simple. And then I just shared it with a few of my friends who had raised venture capital before. And I was like, what do you think of this? What do you think of that? Like, oh, they said, oh, you got to look up for that, this, that, whatever. But generally the term sheet is sort of non-binding, and that you can sign it, you can go through it. We made changes before I signed it, whatever. But at that point, I also spoke to a few friends. I was like, what law firm should I use? They recommended a few. I met with one of the partners. We had a conversation for like an hour or something like that. We had a good rapport. I sent the term sheet over to them. They took a look at it. They made some changes, sent it back. But the big document that comes next is like, I don't even know what it's called, just like the series documents. That's the stuff that's like 30 pages, 40 pages, where you want to make sure you have like good lawyers and that kind of thing.
Yeah. And how much does that whole process cost? Is it,
oh my God,
a couple grand? Is it 10 grand? Is it like,
so what they do is that the lawyers are like, we're going to keep it cheap right now. And then when you raise your next rounds, we're going to hit you with a big bill.
Got it.
So some of them will actually defer it completely, and they'll say, we won't even charge you anything until you raise your like Series A round. And I have friends that have gone that route. I think we ended up paying probably like $3,000 or $4,000 for that initial paperwork. But then when we raised our Series A, technically, I guess you could call it, I think it was about $50,000-$60,000 in legal fees.
Wow.
But that's low. Actually, I think it might have been closer to 100,000. I try to not think about it.
Yeah. So there's gonna be some legal costs, but
but not initially. Like, you can definitely get around it by having a lawyer that will defer it and so on and so on.
Yeah. Maybe to end, this is kind of too big of a topic to end on. I've certainly been critical of crowdfunding. I've been asking lots of hard questions. But
I'm very critical of it, by the way.
But do you think that it could be modified? And because in some ways it feels like it's definitely a great deal for the entrepreneur, right? Like the entrepreneur gets to leverage whatever influence they have and get money directly from fans, many of whom don't even care about the investment part of it. Like, there's definitely some benefits there. Yeah. All of my questioning has been around like, what is really happening here? Like, is this actually, can we call this an investment or whatever? But
I think you should think of it as a gift, but yeah.
As a gift. Yes. But I wonder, is there something that crowdfunding could tweak in your mind that would make it better? And in that case, wouldn't you always want to go that way? Like, just raise money through crowdfunding and, ignore all of this other stuff and just be able to, you could raise up to $5 million a year that way. It seems pretty attractive as long as the ethics are okay.
So in that case, I honestly worry more about the investor in that situation, like the thousands of people that are investing in the company. I worry about them. And I think the ethics there are tricky because these are people putting in $500, $1,000, $250. And to them, it may actually be quite a bit of money. And they're sort of like taking this gamble. And I'm actually kind of concerned for some of these people that are investing lots of money and raising $5 million. And like, there's no plan for liquidity for that company.
Yeah.
So you're kind of out of it. I won't swear on this podcast, but you're not in a good position, I don't think, as an investor in that. So, but could they tweak it? Possibly. But I think it's kind of quite like gambling in a sense, where you're just sort of like, I'm gonna put $500 in and maybe this goes well. But unless you're just simply doing it as a gift, like, I want to support you as an entrepreneur. I've been following you a long time. Here's $500. And like, I just want to be part of this story. And I think that's great. I'm just worried about people that think
how is that different than people investing in stocks?
I mean, I also invest in individual stocks because, I'm not a professional investor. And yeah, I mean, I don't think it should be illegal. Let me be clear. Like, I think you should be able to do crowdfunding. I think Republic should exist, et cetera. I just think that if we want to talk about something that's potentially shady, I think it's entrepreneurs and companies that are raising $5 million on crowdfunding sites at ridiculous valuations that they would never get in the private market, and taking people as suckers who are never going to make a return on their investment. So that's something that you can be critical about.
Yeah. I mean, I certainly have. It just from the beginning, I was always like, like this just seems like such a great deal for an entrepreneur, especially for folks like you and I. Like you and I, if you have any sort of following, you can, it makes sense. And all the pieces are in play of people want to join the journey. People want to be a part of your story. People are happy to support you in the same way that, people support people on Patreon. Or support people on Podia with Podia memberships. It's tapping into some of that same stuff. But what's tricky about it is this is the first time we've done it. And I also like it because I feel like individual investors have been shut out of the stock market. Like it used to be like you could be a part of an IPO as a individual investor, and people used to make money like that. It used to be a life-changing experience for people. And certainly you can lose money, but now those gains are almost all at an elite level. Like you have to be an LP that can invest X number of dollars. So I like the democratization part, but
as I do too.
What's unproven is, and I'm wondering I wonder if you could tweak it so that you can still leverage this. And, so I have it's not very much money, but I have a little crowdfunding portfolio. And basically what I've told people is I guess check back with me in 10 years to see if any of that materialized into anything. And I'm skeptical, but I wonder if there's if you have, if you had to be more clear about how liquidity events were going to work, if you had to, if more of that was kind of in stone, it seems like it could be safer, but
I'm just worried about the people, like the Robin Hood, Wall Street bros types that are, putting $500 into these crowdfunding companies, never to see it again. And so I just worry about that a little bit. But as an entrepreneur, it's amazing. You set your valuation, because typically I don't really get to set my valuation as an entrepreneur necessarily when I'm raising venture. Like there's a discussion and, I'll go up, I'll go down a little bit. They'll go up a bit, whatever. But with a crowdfunding thing, it's just, you're basically saying it and all these people are taking you by your word. And, they're getting crazy multiples and whatever.
Yeah.
But again, I would blame, it ball stops with the entrepreneur, and the entrepreneur that's choosing to do that and then doesn't ever have a plan to have a liquidity event. They're basically stealing from thousands of people, in my opinion.
Yeah. I think a lot of the onus there, although Republic certainly has some culpability. The government has some culpability.
Of course.
There's other folks too. Well, this is great. I really appreciate you digging into this with me, man. And I will say, for everyone who's listening, I'm a big fan of what you built at Podia. I think you've built one of the best team cultures I've ever seen, and one of the best customer cultures I've ever seen. So folks should definitely follow Podia and Spencer Fry on Twitter.
Thank you.
It is honestly one of the most impressive companies. And I peek in your Slack every once in a while, and I'm just blown away by the culture you've created. And
we're VC backed. No,
it is. Yeah, exactly. You're a perfect example of somebody who's built an incredible company, incredible team, incredible culture, incredible product, going this route. So thanks for being.
And let me say to you too, I also am a customer of Transistor, and I think you've built an amazing product, and I love everything you say on Twitter, and I agree with you 9 times out of 10.
Well, that's great. Well, I'm glad we could come together like this and have the conversation. And we'll do it again. We'll see. Well, I'm sure folks will have other thoughts as well. So we'll do it again for sure. This is part of why we do this, is it humanizes all of this discourse. It definitely helps me moderate my opinions. So
Same. Thank you.
all right.